We are going to look at current assets in particular. We're going to go through 5 different categories and what might be included in those categories. So let's dive into this. First item on our list is going to be cash. Cash is going to be made up of all your cash accounts. In this situation, we have 3 cash accounts in our general ledger. We have our operating account, we have our money market account, and we have our trust cash account. Now, our operating account, this is what we're going to use to pay our payroll, our operating expenses, any expense of the business. Our money market account, this is going to be any excess cash that we want to earn a little bit of interest on. We're going to transfer money into that money market account, much like a person would individually. Now, this trust cash account, not every business is going to have a trust cash account, but basically this is a cash account that has restrictive uses, and that's why you have the account set up separately. And I should have said this in the beginning, the 1001, the 1002, the 1003, in this example, those are my general ledger codes in my accounting software. So when I'm doing journal entries or we're paying items at accounts payable or we're receiving money from accounts receivable, we are going to be hitting these general ledger accounts for money going in and money going out. Accounts receivable, this is when you invoice a client for services or goods that you might have sold, but you have not collected the balance sheet. You've simply invoiced the client, but you have earned it or you've provided the services. It is revenue that you are due but have not returned it into cash yet. We're using GL account 1200-1200 in this situation. And I'm just showing a simple aging schedule here to show where my invoices are falling in collection. 0 to 30, that's going to be basically just current invoices. I'm waiting to receive payment. 30 to 60, I'm getting a little bit older. 60 to 90, 90 plus, probably getting a little concerned about collecting payment from that client. This is where you're going to be following up with that client consistently and maybe even getting to the level of 90 plus, sending that threatening letter. Depending on what your AR policy is, I might be sending it to collections because it might be uncollectible or it might just end up being a bad debt. But prepaid expenses. This is where you have used cash to pay for expenses, rent, something that has a future economic value that is not currently reflected or not currently expensed on the income statement. These would be items like if you paid rent 6 months in advance, or if you have a software license that is good for 12 months and it's beyond the balance sheet date. You're going to keep these items in prepaid until you're utilizing that service or that service is no longer has an economic value. And in this situation, I have GL account 1300 and 1310. Prepaid expenses are going to be my operating expenses. My other one's going to be prepaid insurance. These are my insurance policies, whether it's E&O, whether it's D&O. These are insurance policies that have future economic value. I'm expensing them over the useful life of the insurance policy. So in this situation, 1310, I still have $150,000 of insurance value as of the balance sheet date. Trading securities. These are going to be a portfolio of stocks and bonds that you're going to be actively trading and generating gains, losses, dividends, income, etc. These are not going to be long-term holdings. But when you have trading securities, you're going to be marking these to fair market value. Even if you have not sold them, you're going to mark them as unrealized gains and losses. So this is where we're using that 1410 account here. The 1400 is what it costs to buy the securities. The 1410 is adjusting them to what the market value is as of the balance sheet. And then marking them is then reflected on the income statement as an unrealized gain or loss. That is trading securities. Inventory. This is going to reflect our progress of making whatever we are selling, whether it's raw materials that we've bought to make our widgets in this example, whether our widgets are a work in progress. We're currently putting them together, but they're not quite finished yet. We've used some of our raw materials, we've used some of our labor, but the product's not finished yet. And then we have our 1520 account, the finished products. These we have finished, but we have not sold them yet. It's not part of cost of goods sold. So this is inventory. These are the items that we have currently as an asset to sell, whether it's finished, whether it's materials. These are going to ultimately be sold, turned into revenue, but right now they have not been sold because they're either not finished or we just haven't sold them. That is our inventory. This is the second part of a balance sheet. These are going to be your liabilities, and we're going to specifically go over current liabilities today. And I'm going to go through what is in these current liabilities. We have 5 categories on our balance sheet. We have accounts payable, we have accrued expenses, we have accrued payroll, we have our current portion of long-term debt, and we have unearned revenue. We're going to go through each individual piece. First category is accounts payable. These are invoices that we have entered into our accounts payable module, our accounts payable software, whatever we're using to track invoices that need to be paid. Now, these invoices at the balance sheet date have not been paid, but entered. So no cash has exchanged hands with vendors or whoever we're paying. Accounts payable, we're using General Ledger Code 2000, and this is just a very simple aging schedule. 0 to 30, these are going to be my current invoices that we need to pay. 30 to 60, these are invoices, maybe I just have some favorable terms and I'm not paying them right away. Maybe I'm disputing it with a vendor. 60 to 90 days, maybe I have some really favorable terms with a vendor, or maybe there's a dispute I'm having with a vendor and I'm not ready to pay them until we resolve that dispute. 90 plus, I don't have anything in there, for a total of $1.5 million of accounts payable as of the balance sheet date. Our next category in current liabilities is accrued expenses. Accrued expenses, these are going to be invoices that we have not entered into the accounting software, or we might not even know exactly how much we need to pay. Maybe we have an estimate, but we know we've incurred those expenses, and we want to make sure we put those expenses in the income statement and also as a liability on the balance sheet. And in this scenario, we have 2 General Ledger Codes 2100 miscellaneous payables. These are just going to be items that we know we've incurred. They're an expense, they should be an expense on our books. And then taxes payable, GL account 2200. These could be tax estimates. Maybe we're working with our tax accountant who provides a entry on how much taxes we owe for a particular quarter or for the entire year. We could be booking an estimate, or we could be booking exactly what we need to pay related to taxes payable, whether this is federal taxes payable or state taxes payable. And with accrued expenses, these are normally going to be a journal entry that gets posted. There's typically not going to be an automated process that's going to necessarily put this journal entry, at least from my experience, put this expense on your books. So more than likely, these are going to be manual journal entries that you book in your accounting system, so you properly reflect those expenses on your income statement and the liabilities on your balance sheet. Third category is accrued payroll. 4 categories that we're working with. 2400 wages payable, 2410 commissions payable, 2420 bonus payable, and 2430 payroll taxes. Now this is going to be compensation that has been earned in the period that we're reflecting in the financial statements, but has not been paid. That's why we're putting it in the current section of our liabilities. It's owed, but the cash as of the balance sheet date has not gone out the door. Wages payable, more than likely it's going to be salaries. These are folks that have earned their wages or their salary, but we have not actually paid them yet. More than likely, the payroll cycle is going to be after the balance sheet date. That's why you would have this liability out there. Commissions payable, want to make sure any commissionable revenue sales that we're recognizing also has a corresponding commission expense if somebody's owed a commission due to that sale. So that's why you have commissions payable here. Bonus payable, this could be a bonus that is earned as of the balance sheet date, but has not been paid. And then payroll taxes, this is going to be a piggyback of all the different categories. These are payroll taxes that are associated with items that we need to pay. We just have not incurred the payroll expense yet. Once the cash goes out the door, the payroll taxes will follow suit with the net pay that is owed to the employees, whether it's commissions, bonus, or salaries. Our 4th category is current portion of long-term debt. Normally, you're not going to put your long-term debt in current liabilities, except for what is due within the next year. So we have 2 GL accounts here, 2900 and 2910. We have 2 bank loans, and each each of these bank loans is going to go out more than 1 year. But we do want to encapsulate, or we do want to capture the principal that is owed within the next year. We're going to pull that out of non-current liabilities, which we'll go through in a different video. Anything that's over a year, you're going to keep in non-current liabilities. Anything that's due within a year, you're going to put in current liabilities. So you're just isolating those 12 months and putting that portion of principal into current liabilities. And our last category is going to be unearned revenue. We're using GL account 2500, deposits received in advance. These are customers and clients that have given us money ahead of receiving their goods and services. So we have not earned the revenue associated with the cash. So that's why it's a liability. The journal entry you're going to see with this, you're going to debit your cash account, and then you're going to credit this 2500 unearned revenue or deposits received in advance. It's a liability until it's earned. Once it's earned, then this becomes company cash, and you're recognizing the revenue associated with that cash. This is also known as deferred revenue. Unearned revenue, deferred revenue basically mean the same thing. Just to give an example in here, let's say you have a deposit you're putting on a car, but you have not received the car yet. That deposit for the company receiving the cash, they have not earned the revenue because they have not provided the car yet. So for them, that deposit is unearned revenue. Once they deliver the car and you pay for the car, then they can recognize that deposit as revenue for providing the goods and services. All right, that's 5 current liabilities that you may see on a balance sheet. I hope this helped you better understand what current liabilities are. These are liabilities that are due and expected to be paid within a year. Non-current assets. These are assets that are going to have a useful life or an economic value beyond 1 year. That's why they're in non-current. And we're going to go through 5 common non-current assets that you'll find on the balance sheet. First is going to be fixed assets. Then we're going to go over land, intangible assets, goodwill, and then lastly, held to maturity investments. Let's dive into this. All right, our first category on our balance sheet is going to be fixed assets. And you'll see the note, it's net of depreciation. So fixed assets, these are going to be physical or tangible assets a company owns and uses in its business operations to provide services and or goods to its customers, which ultimately generate revenue and sales. And when you have fixed assets, you're going to depreciate them. That's why it's net of depreciation. This isn't the gross amount that you paid for your assets that are on the balance sheet. And our general ledger account for fixed assets in this example is $1,600. And we have 4 fixed assets in our general ledger account that are being depreciated over their useful life. So key information that you need for fixed assets in order to depreciate them is: 1, was it placed in service? When did you buy the asset and actively start using it? What's the useful life of that asset? What was the cost basis of the asset? Over time, you want to track the accumulated depreciation, how much you've depreciated that asset, ultimately to get down to your net value. And a way to figure out what your depreciation expense is you take your cost basis divided by your useful life for straight line depreciation. Now, that's going to be for GAAP. For tax, it can be very different depending on the facts and circumstances. Makers is kind of the default depreciation method for tax, but there's also bonus depreciation and Section 179. I have a video that I'll link in the description if you want to learn a little bit more about Section 179, makers, and bonus depreciation. Tax depreciation is very different than GAAP depreciation, straight line depreciation, but same concept. You're taking the asset and you're depreciating it over its useful life. Going back to this example where we're using straight line, we're taking our cost basis for these 4 assets: the building, the network equipment, PC equipment, desk, and furniture. We have layered in our useful life, the date it was placed in service, and we're taking our cost basis less our accumulated depreciation, ultimately getting down to our net value, which is $760,000 on the balance sheet. And each year that we depreciate these fixed assets, that is going to go on the income statement. You're going to debit depreciation expense and credit accumulated depreciation when you are depreciating your fixed assets. Our next category is land. Now, land normally is going to get bifurcated out from buying a building, a house, Or maybe you did just buy land, but a lot of situations it's bifurcated from purchasing a building or possibly a house in this situation. Now, land does not get depreciated. Land is booked on your balance sheet at historical cost, and you just leave it there and you leave it alone. You don't adjust it to fair market value. It stays at historical cost. You don't depreciate it. It's land. If you start to depreciate land, you've made a mistake. GAAP does not allow you to depreciate land, nor does tax. Land is land. Leave it at historical cost. Our third category is intangible assets. These are assets that will have future economic value, but they're not physical. They're not tangible assets like fixed assets or land are. These are going to be items like patents, brand names, trademarks, copyrights, contract rights. You might have intangibles from business combinations where you buy a business and you are buying a book of business. There could be items related to artistic intangibles where you have a play or a book. Maybe you have a photo or a video or music. These are all intangible assets that you will have on the balance sheet. Now, with intangibles, are going to fall into two main buckets. Intangibles that are amortized and then intangibles that are not amortized. Intangibles that are amortized are going to be much like fixed assets where it looks like depreciation. You're going to amortize your intangible over its useful life. Intangible assets, like say a trademark, where you not necessarily know, you might not know exactly what the useful life of that trademark is. You just keep it on your balance sheet at historical cost. Now, if you later down the road you find that trademark is not worth anything, or it's just not worth what it is on the balance sheet, then you'll take an impairment loss. Now, in our example here, I am showing a book of business that we purchased, and this is just a simple valuation. Just assume it passed all the valuation tests, and this is the true value of it. I bought a book with $150,000 of revenue. The market multiple that I paid for it was 2 times revenue. So the value of the intangible or the book of business was $300,000. So that's how I've determined what the value of the intangible was that I'm putting on the balance sheet. I spent $300,000 of cash to buy this book of business. And then through my market analysis, through my experience, I found these book of businesses are good for 15 years, which ironically is going to match up with what the IRS says these assets are good for 15 years. But they're not always going to match up like that. But in this situation, we have $300,000, a $300,000 book of business. It's got a 15-year useful life. So we are going to amortize that book of business each year. And right now, we have that $300,000 is net of $80,000 of accumulated depreciation. The 4 years that we have amortized it, we've taken the amortization expense on our income statement. So our net value is $220,000. If you look on the balance sheet, you'll see this ties back to the overall balance sheet. Our GL account, $1,650 for intangible assets for the book of business that we purchased. $300,000 cost basis, less $80,000 of accumulated amortization that we have taken, with a net value of $220,000. Now, I just realized I wrote depreciation in here, so I'm going to quickly change that to amortization. Accumulated amortization. So that gives you a sense. We valued a book of business. We paid for it. We booked it in our balance sheet, and now we amortize it over its useful life. All right, goodwill. GL account $1,700 on our balance sheet. It is $100,000. What exactly is goodwill? It is a little bit of a weird concept. And does it truly have future value? Let's just analyze how goodwill got on the balance sheet and what you end up doing with it once it's on the balance sheet. So let's assume that intangible that we were just talking about came through a purchase, a acquisition, and we're doing acquisition accounting. And we paid $475,000 to buy this business. Part of the business included a book of business, which we valued at $300,000. That's right here. But also with that book of business that we purchased with the acquisition, we also got some cash, we got some accounts receivable, and we also got some accounts payable. So purchase price was $475,000, and we got assets of $385,000 in this acquisition, and then we took on liabilities of $10,000. So that's a net value of $375,000. So we've gotten assets of $375,000, but we paid $475,000 to actually buy the business. what do we do with this extra $100,000? As you can see, it's goodwill. Goodwill is the difference between what you paid for in an acquisition less the net assets that you purchased. So our net assets, $375. Business, we paid $475. Our goodwill in this situation is $100,000. Now, if you take that at its face value, you're like, why would I put that on my balance sheet? Why wouldn't I just take that $100,000 onto the income statement? And why am I paying more for a business than it's worth? Well, it's hard to look at a business and say it's only worth its net assets. There might be intangibles that we just do not see there. Maybe we're taking out a competitor. There's probably items in this that we just can't value on the balance sheet, but that goodwill does ultimately have value to us. So that is why we're putting the $100,000 on our balance sheet. I don't think that was a great explanation, but basically it's almost, you can just think about it, it's the plug between what you paid for the business and the net assets that you received. That is your goodwill, with the assumption that that is going to have future economic value. Now, later down the road, this goodwill, you determine maybe this was a bad acquisition, and that goodwill does not have any value to you anymore. In that situation, this is what you do with goodwill. You test it for impairment each year. And if you find that your goodwill, the acquisition of this business, is impaired, then you'll take that $100,000 or whatever the impairment is onto your income statement and take it off the balance sheet. But we're going to assume this was a good acquisition. This goodwill actually has future economic value, and we're going to leave it on our balance sheet, but we're going to test it for impairment in the future. So GL account $1,700, goodwill, the difference between what I paid for the business and the net assets that I have received from the business. Our fifth and final category of non-current assets is held to maturity investments, one of my least favorite categories of investments. I have plenty of videos going over this. I will link several in the description if you want to see why I do not particularly care for held to maturity investments, but we're going to go through it on our balance sheet. So held to maturity investments, these are going to be debt investments. They're going to be fixed income, and we are anticipating holding them until they mature. And because you're holding these investments to the bitter end, GAAP is saying do not mark them to fair market value like you do for available for sale or trading securities. You're going to hold them until you receive the full principal back. So why mark them to fair market value? Just collect your interest, collect your cash once it matures, and that's it. So in this situation, held to maturity, we're leaving it on our balance sheet at cost basis. Even though at 12/31/24, our fair market value is $92,345, we're going to ignore that. We'll put it as a footnote in the financial statements, but for the ultimately in the balance sheet, we're going to ignore the fair market value, and we're going to leave it at cost at $90,000. That's why our cost basis and our balance sheet agree to each other. That is held to maturity investments. Do not mark them to fair market value. Non-current assets. These are 5 common ones that you'll see on the balance sheet. These are assets that are good beyond a year. What is a non-current liability? It is a liability that is not due or it doesn't mature. The maturity is greater than 1 year. This is going to be your bottom section of the liability section. And we're specifically going to look at notes payable, mortgages payable, bank debt, bonds payable, a shareholder note payable in this video. These are 5 different types of non-current. You could also call them long-term liabilities. I think that's the old school name for these. All right, let's dive into this. First category in non-current liabilities is notes payable. We're working with general ledger account 2800 in this situation, and we have 2 notes payable that make up our general ledger account. Now, a notes payable is typically going to be a promissory note. And a promissory note is going to have standard pieces to it. There's going to be a date that it was issued. There's going to be a term of the promissory note. Is it 5 years? Is it 7 years? There's going to be an interest rate. What is the interest that is being charged on borrowing the money? And then the maturity date. When is the note actually due? And what are the terms? Are you paying monthly? Are you paying annually? Is it a balloon payment? What are the terms of the loan? So promissory notes can be more nuanced than that and have a lot of different aspects to it, but those are some core or some key pieces that you're going to see with a promissory note. So within our notes payable, we have these 2 notes that we took out, these 2 promissory notes. one for network equipment, the other for desk and furniture. For the network equipment, we have the issuance date of January 1st, 2022. It's for a 5-year term. It's an interest-only loan, which means we're only paying interest until the loan matures, and then we're making a balloon payment. The interest rate on this is 5%. The loan was $120,000, and the balloon payment is also $120,000, and that is due December 31st, 2027, at the end of the term. So at the end of the term, I got to come up with $120,000 to pay off this loan, but I'm paying the interest along the way. I'm paying that 5% interest. Same thing with the desk and furniture. It's an interest-only loan. I took this out on January 1st, 2023. It's a 5-year, 60-month loan. 6% interest in this situation for $80,000, and it doesn't mature until December 31st, 2028. These are the two notes that make up my notes payable line, general ledger account 2800, that make up my notes payable section of my non-current liabilities. Line item number 2, mortgage payable. We have general ledger account 2950 that is classifying our mortgage, and it's on the building and land that we purchased back in 2010. If you haven't watched my non-current assets video, highly recommend checking that out, because if I go back to general ledger code, if I go back to general ledger code 1600 in my non-current assets, there's the building, there's the asset on the asset side of the balance sheet, and here's the liability attached to that asset. So in the non-current section of our liability section of the balance sheet, we have this mortgage that we took out January 1st, 2010. The original mortgage was $744,000. We have a 6.5% interest rate, and the balance as of 12/31/24 is $220,000. It doesn't mature until December 31st, 2030. That's why we're keeping it in our long-term or non-current section of our liabilities. Line item number 3, bank debt. These are loans that we've taken from a commercial bank, and we've taken out these loans for expanding parts of our business. We have general ledger account 2900 is our bank loan number 1, general ledger account 2910, bank loan number 2. And if you haven't watched my current liabilities video, highly recommend checking that out, because we have the current portion of our long-term debt sitting in current liabilities. This is what's due within a year. Honestly, I should have done that with the mortgage payable. I didn't in this scenario, but anything that's due within a year, you're going to stick in your current liability. So just take note of that. So non-current liabilities, this is the portion that is due greater than a year. And much like a mortgage, much like a promissory note, there's certain aspects of debt that just kind of carry forward, and no matter what kind of debt that you have. We have a date that this was issued or funded. This is when the bank funded these loans for us. There's an interest rate and there's a maturity date. These loans aren't due until 2025 and 2026. That's why I have them in non-current liabilities. And this is the balance that is owed as of 12/31/24. That will tie back into our non-current liabilities section for bank debt of $840,000. Again, this is just loans that you're taking from a commercial bank. You're paying back on the terms that you signed up for. Line item number 4, bonds payable. Our general ledger account 2810. Bonds are another debt instrument, and you're typically going to go to an investment banker to help you issue bonds, because you can issue these to the public, so anyone could buy bonds of the company that I'm running. So in this situation in 2022, we had a bond issuance of $1 million at a 5% interest rate. We also have our maturity or redemption date for the bond. This was a 10-year bond. And a lot of times you're going to use this. This is another form of raising money to expand your business, to buy capital assets, maybe do an acquisition. Not in this video. We'll go through equity financing, where you're raising equity. You're selling stock to raise cash as well. Bonds is just debt. You're going to pay that back to the person. They actually have no ownership of your business. Category number 5, our final category, a shareholder note payable. And when you have a close business, or you have any type of business that has shares of stock, as people get closer to retirement, they're going to want to sell their shares. And in this instance, we have a John McClain who has sold shares back to the company and you have not fully paid them for those shares. This happens a lot when you have shareholders that just are heading towards retirement and want to sell their shares. And if you're in a small business that doesn't have enough cash to fully pay for their shares at the fair market value, then you might issue them a note. In this situation, we've issued John McLean a note for the shares that we have bought back from him. And the date of this issuance was 1/1/2024. It happened this year in the balance sheet, in this balance sheet, since it's a 12/31/24 balance sheet. It's a $200,000 note payable, 8%. And we're going to fully pay this back to him on January 1st, 2026. There's a 2-year loan. I'm making this up, but we're going to say it's interest only. We're paying him 8% interest over the next 2 years, and then we'll fully give him the $200,000 when it matures, and that will keep it in non-current liabilities. And this is really typical in a small corporate business that just doesn't have the cash flow to fully pay a shareholder who wants to retire or redeem shares right away. All right, that's non-current liabilities. 5 types of non-current liabilities you can see on a balance sheet. These are liabilities that are not due within the year. That is why they're non-current. So what is in stockholders' equity? What are typical things you're going to see in stockholders' equity? We're going to cover common stock that's issued at par. We're going to cover common stock, the additional paid-in capital, treasury stock, retained earnings, and dividends. Let's dive into this. Before we go into the categories that we just outlined, I want to go over this concept of shares authorized, shares issued, and shares outstanding. Shares meaning stock. This is going to be stock in a C corporation, S corporation. Shares authorized means these are the amount of shares the corporation can ultimately issue. So they can ultimately issue 10,000 shares. That's the maximum amount of shares that can be out there or owned by stockholders. Now, that can be adjusted. You can go to your articles of incorporation and change that. But from the beginning, you have to determine how many shares you want to authorize. Now, the next level down is shares issued. Out of that bucket of shares that you have authorized, how many have you actually issued to shareholders? And in this situation, we've issued 2,000 shares. That means there was a stockholder that currently owns or has owned those shares of stock. The corporation can still issue 8,000 more shares without changing its articles of incorporation. And then the next level down from there is outstanding. How many shares are currently outstanding? How many shares are actually owned by shareholders? And that is the difference between authorized, issued, and outstanding. A lot of times you're going to see issued and outstanding be the exact same number, but we're going to go over why that number can be different when you're looking at a balance sheet of a corporation. So let's dive into our first category, which is common stock issued at par value. Okay, this is our 3,000 account. This is our first line item. Common stock issued at par value. With shares of stock, you have to establish a par value, which is basically the minimum value that stock can be sold or repurchased for. In this instance, we have a $100 par value. These shares of stock cannot go below or cannot be sold or repurchased for less than $100. In our scenario here, we've done 2 share offerings. One in 2009, we issued 1,000 shares at $100 par value. Par value doesn't necessarily mean that we sold it at $100. It just means it cannot be sold. Those shares of stock cannot be sold for less than $100. So I'll explain that in our next category, additional paid in, but just follow me through the par value. So we're going to debit $100,000 of cash for the par value portion of the common stock and credit common stock par value. Now, if we sold it for more than $100 a share, we'll go over that in 1 second. In 2023, we issued 1,000 more shares at the par value, $100. So we're going to recognize that same journal entry again in 2023. We're going to debit cash of $100,000 for the par value portion of the stock we issued, and we're going to credit common stock par value. So let's transition over to additional paid-in capital, because that's the other part of this equation when you're issuing shares, especially when you're issuing shares for more than par value, which is ultimately always going to be the case. I'm going to leave 3,000 common stock par value there so you can see the full situation that's happening here. Anything over the par value is going to get recorded to additional paid-in capital. So for example, in our 3,100 common stock additional paid-in capital account in 2009, when we issued the 1,000 shares, the share price was actually $150, which was $50 over the par value. So the total amount we raised in 2009 when we issued those shares was $150,000. When we record that journal entry, but we're going to break down the share issuance between par value and additional paid-in capital. So the par value was $100 a share. So that's that $100,000 we went over before. The difference, the $50 over the par value price in our share price that we offered these shares for is $50,000. The $50 times 1,000 shares. Or you can think about it, we raised $100,000 of that was par value. $50,000 of that is additional paid-in capital. So when we record that entry, we're going to debit the cash for $150,000. We're going to credit par value stock for $100,000, and then we're going to credit additional paid-in capital for the difference, the $50,000. So that's how you break down when you issue shares between par value and additional paid-in capital. So let's just run that back for 2023. We issued 1,000 shares again. The par value stays the same. It does not change. It's $100 a share. The par value is $100,000. But the stock price we sold these shares for was $225, $125 over the par value. So still issuing 1,000 shares. We raised $225,000 in this share issuance. The par value is still $100,000 for 1,000 shares, but the additional paid-in capital now is $125,000, the difference between the par value. The share price went up, we raised more money, and the difference is put in additional paid-in capital. So my journal entry in this situation is going to be debit cash, credit common stock par value, $100,000, credit additional paid-in capital for $125,000. So as the price goes up when you're issuing shares, the more you're going to have an additional paid-in capital. Par value of stock is going to remain the same. Par value can be wildly different between corporations. It could be a penny. It could be fractions of a penny. It could be $10,000. It really depends what you set up when you set up the articles of incorporation. So that's par value tied into additional paid-in capital when you are issuing shares. And just to recap, these are shares that have been issued. You've taken it out of your authorized bucket, and as long as you haven't bought them back, the corporation has not bought them back, they will be outstanding as well. So let's see why in the scenario here, we have less outstanding than we have issued. Going back to our balance sheet, we've got common stock par value, common stock additional paid-in capital, and now we're going to introduce this treasury stock concept. And I'm using the cost method. In our example here, the corporation on January 1st, 2024, repurchased 800 shares at a share price of $250. Going back to the shares authorized, shares issued, and shares outstanding, that's why we have a difference here, because in 2024, we took 800 shares out of circulation. The corporation bought those back. I also want to recommend watching the non-current liabilities video that I have here, because I give an example of a shareholder note payable. So in this comprehensive example, the corporation has bought back 800 shares at $250 a share for a total price of $200,000. And we have issued the shareholder a note, John McClain in this situation, for $200,000. We didn't give him cash right away. We gave him a note. I just want to tie those in together. I highly recommend watching the non-current liabilities video. I will link that in the description so you can check that out after watching this. So going back to treasury stock, as I said before, John McClain, we've taken 800 shares out of circulation. We only have 1,200 shares outstanding. We are going to debit treasury stock, 3,200, on our balance sheet here, 3,200. And you can either, depending on how you finance it or how you pay for these, you can either credit cash, if you give the cash to John McClain in this situation. But if I tie it into my non-current liabilities video, we actually gave John McClain a note payable. He doesn't own those shares anymore. He now has a For him, it's a note receivable. He's going to be collecting that money in interest. To the corporation, it's a note payable. We owe John McClain that $200,000 plus 8% interest for buying those shares back from him. Now, our fourth line item here and our fifth line item here, retained earnings and dividends, are going to be tied in together. I'm going to start with retained earnings, and I'll explain why I have dividends out there, because some of you might look at that and be like, why does he have dividends out there? Okay, 3,300 is our GL account for retained earnings. Retained earnings is the cumulative net income that this company has retained over its life, less any dividends that have been paid out. So every year, net income gets closed out from the income statement onto the balance sheet in this concept called retained earnings. It's basically the profits the company has accumulated and maintained on its books and records since it started. And the other aspect that will lower that, assuming you have net income every year, it's going to keep going up and up and up. Your retained earnings is just going to get bigger. What lowers that is paying out dividends. But you will ultimately close dividends into retained earnings. So retained earnings, when you're closing your books, staying on that topic, you are going to, when you close out the income statement, you run year-end procedures, it's going to close all your income statement accounts. It's going to debit the revenues, it's going to credit the expenses, and the other side of that entry, which ultimately is net income, is going to be retained earnings. That's 3,300. A lot of times your software does this for you automatically when you're doing the year-end close. I can't think of an example where I've actually done those journal entries in a software or accounting software. But if you had to do it manually, when you're closing out your income statement, because the income statement is just going to be on a 12-month basis, you would debit your revenues, credit your expenses, plug the net to make that journal entry balance would be retained earnings. That is what your software is doing when you're closing out years to the balance sheet. In our scenario here, 3,300 retained earnings, our beginning balance was negative $140,000. We actually had a cumulative loss in this business. Now, 2024 was a great year. We almost had $1.2 million of net income. So when we're closing out the 2024 year, we're going to take our starting balance of negative $140,000 of retained earnings, debit balance, and we are going to credit $3,300 for the net income related to 2024 to ultimately bring that cumulative balance up to $1,050,000 of retained earnings in this corporation. Now, jumping down to our category number 5, dividends are going to get closed into retained earnings. I just wanted to highlight during the year, when you have dividends, you might be just having a subcategory or a GL account to record the dividends to ultimately close into retained earnings. That's what I've done. I have found that helpful for tax preparation. So in this example here, December 5th, 2024, a $100,000 dividend was declared. I'm recognizing it in 3,400. But if I jump back to retained earnings, because I can't carry it into the next year, you close the dividend into retained earnings. So in this situation, I'm going to debit retained earnings. And I'm going to credit dividend, my 3,400 account. And what that will ultimately do, I just want to give you an example of how that looks. So total retained earnings, $1,050,000 right now. That's our ending retained earnings balance, which we roll in the net income from 2024. And when we close out the dividend to retained earnings, since retained earnings is a credit balance, so dividend here, that is going to reduce our retained earnings. So ultimately, when I do the year-end close, I'm not going to do this in this full balance sheet here. Ultimately, the retained earnings will be $950,000 once I close out this dividend that was declared. And the balance sheet will ultimately reflect 0 for the dividend, and it will reflect $950 for retained earnings. But I just wanted to go over that so you can see how that happens on the balance sheet. and when you what happens when you do a year-end close, when you close out dividends to retained earnings. All right, that's equity on the balance sheet. It can be complicated. It can be confusing. I actually think it's one of the harder sections of the balance sheet compared to assets and liabilities. I hope this was helpful. I hope you got something out of this, and I will see you in the next video. Take care and goodbye.